everyone, and welcome to the investment meeting for July 2013. Let's quickly go around the room, introduce ourselves for the record.
Good morning, everyone. Rosemary DeBellis, representing Police Commissioner Kelly.
Barry Dennis, SAS.
Dan Torelli, PBA.
Joe Alejandro, PBA.
Chris McGrath, PBA.
Bob Daly, SBA.
Lou Turco, LBA.
Roy Richter, CEA.
Ken Sparks, DEA.
Tom North, Actuary.
Yvonne Nelson, Controller's Office.
Barton Gantz, Controller's Office.
Seema Hingarani, Controller's Office.
Ted McTeague, Controller's Office.
Larry Schloss, Controller's Office.
Bob Goldrich, Mayor's Office.
Justin Holt, Department of Finance.
Janice Emery, Mayor's Office.
Kevin Holleran, Police Pension Fund.
Nicole Jambrisi, Pension Fund.
Asher Grossman, Controller's Office.
John Mercerberg, Controller's Office.
Moraima, Controller's Office.
Okay, with that, Larry.
Okay, let's look at the monthly numbers. I think everyone has them for May. Anybody need a copy? Color? All good. Let's start. Well, let me give you a couple of quick opening remarks. How quick it is. So, I guess the simplest way to put it is we've had sort of an initial failure to communicate, which was then subsequently recommunicated and continues to be recommunicated and somewhat understood or not misunderstood. That being, the Fed is trying to tell the world what it wants to do, when it wants to do it, how it wants to do it, based on what it wants to do. None of which is a surprise, but the markets reacted quite angrily, as we're going to see in May, and more angrily in June. That said, I would think that the Fed didn't mean it to happen, so the Fed sort of started trying to communicate again, sort of in Mayish or June-ish, that says, hey, you guys are not listening to us very much. We said the following, and the market sort of calmed down. So now we're past that. Now it's July. We've got some new levels. We'll talk about those levels, and life goes on. But it was unfortunate for us since a lot of turmoil happened in May and June, the last 2 months of the fiscal year, more June than May. We don't have the June numbers, so I can get you sort of a running start on where we think it might end up for the end of the fiscal year, which I know everybody cares about. But it was useful for the pension fund that we started with a very, very good running head start into all the turmoil that happened in the bond market. Just to give you a for instance, so in April, the 10-year Treasury was about 1.61%, and it ricocheted itself up to about 2.8%, which is sort of an unheard of amount of money to ricochet up to in the span of about 4 weeks. So it caused all sorts of havoc in the bond markets and losses, and then the stock markets said, my gosh, if you guys are upset, we're upset. Then the stock markets rolled over, and then the Fed came out and said, hey, calm down, everybody. This is what we're trying to get to. And then, again, things became a little more balanced. But there was a lot of money that was flushed out of the system. We were set up as well as you could be set up for all the things that happened. So if I can get you to look at page 34. So 34 are the May markets.
Is it no sheet?
No. 34. So if you look at again, and this is the May numbers. The May numbers are the numbers that are in the book. So I'm going to walk you through that, and then I'll talk a little bit about the June numbers. So the U.S. stock market was up sort of 2 or 3%. You can look at EFA and the emerging markets, again, is the far left-hand column. We're down about 2.5%. You see the Treasury market was down anywhere from 2 to 4%, depending on what you looked at. TIPS in particular were down, further down the page, were down 4%. So what you have is bond market's down, stock market's still going up. If you go to page 30, you can see how we were set up. Substantially the same as before. We were long U.S. equities, and at the bottom of the ranges, 4 plus 5 in TIPS. We funded some hedge funds that we committed to. We topped up EFA a little bit to get in balance. We continued a little program we have of selling down high yield, which was good, and we used some cash as well to fund those things I mentioned. If you go to 35 now, again, we're long U.S. equities. U.S. equities are up 2+%. The bond markets were down. So when you look at the 1 month of May, we still made money. So we're up 40 bips. And the fiscal year to date, you're up 14.5. Good. You know, we're good. Now take this page that we handed out, which is the not so good page. This. These are the June numbers. The far left-hand column. The first block of the stock market, remember we're long U.S. equities, so those are down sort of 1 to 2%. The worst numbers are further down. EFA and emerging markets, the second block of numbers, EFA is down 3.5 and emerging markets is down 6. Go further down, governments are down 2 to 3%. Go further down again, and tips are down 3.5%. Now remember, we're at the low end of the ranges on the governments and the tips, so that was the right thing. We do, however, get clocked because we're in equities. So, a negative month, let's say. So the question is, how negative? Every number on the page is negative, so there's no way you can have a positive outcome. It's some dollar-weighted average of the equities, which, if you look at it, bounce around from down 2 to down 6. So call it down, I don't know, 3, if I have to pick a number. And then if you look at the bond stuff is down 2.5 to 3.5. So let's just assume the whole thing's down 3-ish coming out of June. But you're down 3-ish if you go back to page 35. You were up 14.5 coming into down 3-ish. So at the end of the fiscal year at 11 plus 11.5, 12. You know, that was very quick math I just did. I think we're probably in the right zone. We're working on numbers now. We'll get you a flash as soon as we get to a responsible number to give out. But back of this envelope gets you plus 11.5 to 12-ish. And part of it also depends on the managers. So these are benchmarks. You know, managers can get whipsawed either way, for the good or for the bad. Then if you go to page 27, you see again we had a great year going, and if you took the May number and added it, we were coming into June at about $29.4 million. And again, if you take 3-ish% off of that, you get the number, some number that's 28 plus. I'd like to think that, you know, it's 28 plus. We came in at a little north of 25. So call it 11.5, 12-ish, and 28 plus. And as soon as we come up with some more refined numbers, we'll get back to you. Any questions, any of that? Okay. That ends our agenda.
Bob, if I can ask you a question. On the skim, I can ask you for the variable supplement funds. What's the, on this sheet that I'm looking at, ends June 30th, is that the difference between the trailing S&P 500, 20%, and the T-bill, which is at 0.11?
Almost. It's a comparison between the return on the equities and a bond yield that I believe we use 112% of the 10-year yield averaged over the fiscal year.
110%.
So it'd be around the 2%. But it has to be compared, as you know, against a accumulating deficit that is still quite large. However, it's now getting close enough to actually start worrying about the calculations again.
Because 18% of $29 billion is a lot of money, right?
Well, it isn't. It isn't 20. Okay.
Well,
Yes.
That's union numbers.
Yes, we will do the calculations over the course of the next few months and try to find out how big the remaining deficit is.
Thank you.
So motion to go into executive session.
Okay, let's take 5 minutes to break down the cameras.